Investments in securities are subject to market risks. Read all related documents carefully before investing.
Hello and welcome to the Weekend Investing Daily Bytes. We are shooting this episode on 31st of May. And today, the market, after a long time, showed some signs of weakness. And that, relentless move up seems to have, been stopped in its track for now. Uh, the sub segments of the market, the mid cap and the small caps, were doing still quite well, but Nifty, for a change, was a bit weak, and it initially I thought that it had just come down to cover this gap, which may still be the case. We'll find out in the next few days. But more than that, I think the bank Nifty got really smashed during the day. The Nifty heat map also, if we see, pretty much red across the board. And I've always believed that the banking and finance sector is a very leading sector when it comes to intermediate moves. State Bank down largely because of the dividends going ex dividend, but Reliance, ITC, ONGC, Mahindra, NTPC, JSW Steel, ICICI Bank, Kotak Bank, HDFC Twins, all Axis Bank, all were down today in unison, and it seems like the market wanted to take rest. There was also a MSCI rejig that was to happen, so a lot of money going in and coming out of stocks. But I don't think these were the stocks impacted here. Kotak Bank, maybe yes, some buying was witnessed in Kotak Bank that uh, was supposed to go up. Uh, Nevertheless, the sectoral overview remains sort of a mixed bag, with real estate still leading the day at 0.8%, pharma up 0.6%, consumption stocks at 0.5%. But energy, commodities, and metals took the most of the brunt, with Nifty also closing about 0.5% lower. Bank Nifty, which was down more than 1% at one point, also closing at minus 0.7%. So a good shake-up today. I think also on the back of very weak Asian cues this morning, with Nikkei and Hang Seng losing a lot of ground. Hang Seng, the Hong Kong index, is now at the same place where it was 25 years back. So just imagine the kind of values destruction that has happened for investors there. Chinese market, I think, is down again close to 15 or 16 years from where it was before 2008. So, I mean, what we have here going is exceptional, and we must be grateful that we have such a vibrant market going on for us. Mid caps not deterred by this MSCI rejig and this move today. Yet another highs at 33,761. Small caps in the last 1 hour actually shot up dramatically, and now the small cap index has also uh, crossed the 52-week high. It's still a bit away from the all-time high, but still at 52-week high. And you can see that from 8,500 it has just relentlessly gone up to 9,900. So a nice 15-17% kind of move already in here. Nifty Bank had broken out of this all-time high level, uh, and today it was trying to break down on the downside again, but remained very choppy. Picked up from the bottom quite a bit, recovered a lot of ground, but I don't know. It does seem like some weakness has crept in this session. Today we will discuss about Philip Carret. Philip Carret is a legendary investor, and this is the book by Philip Carret, Art of Speculation. Uh, he was the manager for the Pioneer Fund in 1928, just before the Great Depression, and he saw the depression. He saw World War II, bear markets in 1970s, and he retired in 1983 as a portfolio manager. And he lived through 31 bull markets, 30 bear markets, 20 recessions. So I don't think, besides a few folks, maybe like Warren Buffett and a couple of others, anybody has had this kind of an experience, uh, with market cycles and the time period that they've seen. And Warren Buffett himself calls him one of his heroes, and he says he's had the best long-term investment record of anyone I know. So if Warren Buffett is crediting Philip Carret with such praise, I am sure the returns would be dramatically good. Uh, the uh, The basic tenet for Philip Carret, he has divided them into 12 uh, commandments in his book, and he claims that investing genius is basically patience and compound interest put together. So, if you really simplify his approach, it is essentially patience and compound interest coming together. 79 years of successful investing, and will go through his 12 mantras of 12 commandments of Philip Carret. So his first commandment is never hold fewer than 10 different securities covering 5 different fields of business. So essentially, talking about diversification within your equity allocation, uh, no less than 10, uh, could be higher, but no more than 2 stocks per field of business, so that you have adequate diversification within your minimum 10 portfolio. Extremely good rule here. Then the next rule, he says, next commandment says, at least once every 6 months, reappraise every security held dispassionately and as if you were approaching that stock again. So, in that sense, uh, it's like a rebalance every 6 months. So, like we do a rebalance every month or every week in weekend investing. So we are actually looking at a reappraisal of the security that we're holding, whether we should hold it or not. And you need to be dispassionate about it because you've held it for so long, so your emotions may get tied to it. But what you need to do is to, like an outsider, take a look at it, that does this stock belong in your 10 stocks anymore because of the current situation. And that is the sort of 6 monthly reappraisal that you need to do. And then he says keep at least half of the total portfolio in income producing securities. So uh, essentially, stocks that generate uh, dividends, stocks that will produce you income, should be half of them. But to some extent, those times of 20s, 30s, 40s were very focused on income and dividends, and over a period of time the focus has moved towards growth and lesser of dividend payouts. So to that extent, that change in time period in the last many decades has caused a slight shift in how the markets are getting approached now. The fourth commandment was consider dividend yield the least important factor in analyzing any stock. So I also see that in our markets also, sometimes some companies will come out with huge dividends at stock prices which may not be sustainable, but or the dividends themselves may not be sustainable. They may have had some good year or something like that. So dividend yield probably should not be your key criteria for selecting a stock, unless it's a utility kind of a company where dividends have been very steady and stagnant over a period of time and slightly growing with the company. So dividend yield is to be the least important factor. The very important commandment, fifth commandment, is be quick to take losses and be reluctant to take profits. This is very, very important. I think this is the key to successful investing, which in weekend investing also all our strategies are built around this tenet only, that we will take a lot of small losses, but we will allow our winners to run. If your horse is winning the race and there are 5 laps to go and you are in the fourth lap and you're winning, why would you want to stop him there? You ought to let your winning horse run as much as he wants to run in a winning position. The next commandment is never invest into securities about which detailed information is not readily available. So this is more of a fundamental approach, but those who do fundamental approach would want to know everything that is available about the company, and what is not available they should try to find that out, because otherwise as a fundamental approach it will become like a throwing money in a dark hole, because that is where your expertise was required to analyze the company using that information. If that information is not available to you, your thesis may be half baked, and that may hurt you. The next commandment, very very important: avoid inside information as you would the plague. So while a lot of people would run after inside information, more often than not, even insiders are very surprised at the expectations of the market and how markets react to various news. Over the last 27 years that I have been in the market, I have seen many cases where people who work in certain companies are so overconfident about their own companies that they are very surprised at the outcome of the market, that, oh, I did not ever imagine that my company stocks will go down like this, or that despite our great results our stocks are down like this. So avoid inside information, because insiders are heavily biased and not always correct, and of course it is illegal as well. So you don't want to get into that kind of a situation. The next commandment is of seeking facts diligently. So seek facts, but not advice. So build your core competency in such a way that you gather data and you should be able to analyze that data and take your decisions, rather than taking opinions or advice from somebody else who may be biased or who may have incorrect method of deriving uh, uh, you know analyzing the facts that are presented to you. So essentially improving your ability to read data and to deliver knowledge out of that. Ignore mechanical formulas for value in security. So a lot of times for valuations, a lot of mechanical formulae are used, but the market doesn't really. For instance, like price earnings ratio is one of them, book value is another one of them, so on and so forth. So these factors or these mechanical formulas for calculation, while they are okay to have that knowledge of that value, but that cannot become the basis, because the market can behave in a very different way. What may seem like a cheap stock to you, maybe a very expensive stock, because the market knows that the stock is going down. Or what may seem like a very expensive stock to you, maybe a very high growth stock, and the market may be easily be able to navigate a 50 times price earnings for that. So mechanical formula will deter your success rate, I think. And as per Mr. Carret, uh, the next commandment is, when stocks are high, money rates rising, and business prosperous, at least half of the portfolio should be placed in short-term bonds. So this is about asset allocation, where in every boom cycle, when stocks are running very high and interest rates are also rising, and business is propagating like anything, so there is no clouds on the horizon, then he propagates that at least 50% should be placed in short-term bonds to safeguard some of the profits. Next commandment: borrow money sparingly and only when stocks are low. money rates are low and falling and business depressed. So having gone through the Great Depression and 20 bear cycles, this is his learning that first of all, don't borrow money usually. But when stocks are extremely low, market rates are extremely low, and falling, and business is overall very depressed, it is at that time that you may want to take that call. Uh, and that is the only time when you should be borrowing money for market investing. Although personally, I would not even do that, but this is the commandment that he lived by, and he was very successful with that. Set aside a proportion of funds for the purchase of options in promising companies. So he did, emphasize on leveraging it up a little bit. So maybe if 50% is in bonds, 50% is in equity, maybe 5-10% out of your equity portfolio, you can look at leveraging your existing portfolio. So if you're holding, for instance, some stocks that are available in options, and you feel that those stocks are really doing well over the next few months, you could look at leveraging it up using options in promising companies. So amazing 12 commandments. Several of these commandments actually, we found that we are mirroring them in weekend investing, although our approach is totally very different using momentum investing. But nevertheless, I mean, the importance of diversification is principally up there in every weekend investing portfolio. We review and rebalance our portfolios, reappraise the securities held, on a weekly or a monthly basis. We definitely cut our losers early and let our winners run far, and that is the key to why weekend investing strategies over a longer period do all right. And we only invest based on facts, data, price, and volume, and not on rumors or hearsay or what our forecast is. So this is very, very important, that we remain totally clear about what to buy, when to buy, how much to buy, and when to sell. And all these principles, when they come together in a dispassionate and a totally academic way, is when you will actually be able to do extremely well in your portfolio investing. Thank you so much for watching this episode. If you liked it, please give us a thumbs up, or subscribe to the channel. Offer a comment in the comment section if you like, and I will see you in the next one. Thanks. Bye.